So I'm going to cover one key tip for increasing the amount of income you can generate through your retirement years. And this tip will be related specifically to your retirement portfolio. You know, the backstory to this whole discussion is the fact that interest rates up until very recently had been very, very low. So retirees were challenged to generate satisfying returns that would generate income but also protect their purchasing power. Historically, most retirees would want to buy guaranteed investment certificates, savings accounts, money market accounts, short-term bonds, and T-bills. They wanted to be cautious and conservative with their portfolio while at the same time generating a consistent income. But for a long time, that consistent income just was not cutting it. So over the years, a lot of alternative investments have built up, and those investments promised much higher yields, much more sustainable income to cope with inflationary pressures. Examples will be real estate investment trusts, dividend ETFs, dividend stocks, and ETFs using such strategies as cover call strategies to try to boost the income on the portfolio. Now, are those good options? Well, it depends. We're going to talk about that in a bit, and then I'm going to talk about a better long-term sustainable strategy for generating retirement income. So like I said, the quest for getting yield has really driven people in the direction of alternative investments. And I'm not saying these investments should not be used for portfolios, but I do think sometimes people get so focused on yield that they miss the big picture and could be actually hurting the retirement income over the long term through the retirement years. And I'll talk about, again, some very important information to set the stage in that area. But first, let's look at the current strategies that are gaining traction, and I'm going to question these trends. So let's take a look at some of these observations. So first of all, you know, when a strategy is promising to generate yields double or sometimes triple the risk-free rate, it's important to be a little bit skeptical about the long-term sustainability of these strategies. At the very least, make sure you're doing your homework. So these strategies may work now, but will they work over the next third of your life through your retirement years? That should be a question that you wrestle with. Well, I hope you're enjoying this video. If you are, give us a thumbs up. And if you haven't subscribed yet, make sure you do that so you don't miss future content that we put up on a regular basis on all things retirement. As well, if you go to the show notes, there's links back to our website where you can find out how you can get a complimentary retirement income plan, as well as free educational resources. The second thing, if it's such a good strategy, why are larger private or institutional investors not embracing these strategies with much higher allocations? Why are they not putting a ton of their money in REITs or investment trusts or cover call strategies? Why are they taking a different approach to their asset allocation that many retail investors are? And the third, why does it seem that smaller retail investors are picking up this strategy? One reason, I think, is they want to have their cake and eat it too. We want good income. We want to have a portfolio that we think is conservative and relatively risk-free. And I do think there's a lot of people trying to squeeze out as much income from their portfolio because that portfolio may not be quite as large as they'd hoped it would be. So the minute you're under $500,000 in portfolio assets, you'd be a smaller retail investor. And often in that situation, you're trying to push out as much income as possible. And that can create some challenges for you over time. We'll talk about those challenges in a minute. And then I think there are three other issues we need to focus in on. And so when I talk about a strategy that we use for our clients, it's partly motivated because of these three risks. So the first one is if we get too focused on just yield, we begin to stretch for yield. And what I mean by that is we focus only on income-generating investments, but we might be using income-generating investments that expose us to too much risk, too much leverage, too many, cute strategies to try to generate that additional income for their investor. So actually, rather than becoming less risky, the investor becomes more risky. The other thing is you may fail to diversify. And when things are going well for certain investment categories, we tend to fall in love with our best performing investments and fall out of love with our worst performing. But if you have another third of your life to live in your retirement, that's just not a good strategy. It's going to come back to bite you eventually. If you get too focused on one asset class or one strategy, it will hurt you eventually. And then lastly, you may not generate sufficient income and be forced to liquidate capital. I'm going to show you a chart that will be very representative of what I see often when I do a retirement income analysis for a client. And that is that over time, as they cope with taxes and inflation, they have to begin nibbling away at that goose that lays the golden egg. And even though their portfolio may be generating decent cash flow, they begin to sell off assets to produce more and more income to cope with inflation. So the question is, does your golden goose lay a consistent number of eggs so that you can just take the eggs out? You never have to kill that goose that lays the golden eggs. But unfortunately for many people, they do have to take slices of that goose every single year, and ultimately what that can do is reduce the cash flow that their portfolio will generate. Now, what I'm going to show you now is a couple of charts from the financial modeling software that we use. They're really good illustrations to talk about this issue around killing the goose that lays the golden egg. So this first chart comes from our financial planning software, and all it is showing you in the purple here is the cash flow need. That's an after-tax cash flow. This pinkish color is some pension income splitting that the client's doing to the spouse, and then the tax bill. So they need to generate $49,000 per year of income, and they're inflation adjusting that income at 3% per year. So that, income's going up every single year because of that inflationary pressure. So when you take a look at that, you know right away that that might put pressure on the goose that lays the golden egg. And of course, in this particular file, that's exactly what's happening. So as a client transitions into retirement, the portfolio kind of holds its own for a while, but then it begins to lose ground. And that goose really is getting sliced up over time as we go through the retirement years, so that by age 95, there are no financial assets in the portfolio. Now, what this will tell you right away is that we are encroaching on that income. We can have some really great assets generating fantastic cash flow, but if we're having to sell off those assets, the capital value of them, that will just reduce the cash flow you're going to generate. And that is a real risk for retirees. So as you build your retirement portfolio and you've got some great investments, your covered call options and your high dividend paying stocks and your REITs that are just generating superb cash flow, and you've got everything set up, if you never do the analysis properly, likely what's going to happen is this chart for you. You'll eventually begin encroaching on capital, and this is a very common scenario for many retirees. Very few people can just put that goose in place, have it lay that golden egg, and never touch the goose. That is not the reality for most people. They are encroaching at some point in time. And that's one of the main reasons why this focus on yield and yield instruments likely is not appropriate for many investors. So I'm going to submit to you that if you do not want your goose to get killed too quickly, you need to move away from being singularly focused on income, whether that's using covered call ETF strategies, REIT investment trusts, a pure dividend-based strategy with common shares or preferred shares, and focus on a strategy that has a likelihood of giving you more total return. I think the solution is not just focusing on yield, but focusing on total return. So I'm going to go over a chart right now to give you some data that really informs some of my perspectives on retirement portfolios. So this chart was put together by our research group. Initially, it was just to look at equity versus fixed income investments and GICs. And I'll just go through the basic information on this chart, and then we'll kind of drill down into it in a little more detail. The chart goes through 2003 right through to May 2023, so basically 20 years in terms of data. And the chart illustrates how a $100,000 portfolio grew over that 20-year period. And what you can see here is the $100,000 that was invested in a one-year GIC over that time period grew to $128,000, or 28% in total over that 20-year period. If you just put your money in three-year GICs, it grew to $140,093, or a total cumulative return of 40%. If you put your money in an aggregate bond portfolio, so that's basically the bond index, it's a broad index of various bonds, government bonds, corporate debentures, your portfolio grew from $100,000 to $206,826, so it grew by 106.8%. And if you just put the money in the Canadian stock market, the S&P TSX, you're looking at a growth to $497,485 from the $100,000 initially invested. So it grew to 397% cumulative return, almost 400%. And of course, the Canadian stock market wasn't the best performing stock market over that time period, but overperformed or outperformed the GICs by a wide margin. Now, of course, everyone would say, but Shaun, look at the fluctuation in this blue here. So there's no doubt that there's greater fluctuation. And that's the same with almost all asset classes. The greater the short-term fluctuation or risk or variability of return, the greater the potential for growth. Now, what I didn't have in this chart when they did the research for it was how did a dividend-based portfolio do? So I took the iShares S&P TSX Canadian Dividend Aristocrats Index ETF, cumulative growth starting in 2006. We didn't have it back to 2003 in this particular data set, but it grew 188%. So we're missing a little bit of growth, but I suspect the cumulative growth would be less than 200%. So we have 1-year GICs grew by 28%, 3-year GICs 40%. A bond portfolio grew by 106%. A broad-based index buying dividend-paying stocks grew by 188%, and the pure stock portfolio, Canadian equities, grew by 397%. So what's going to happen over time likely, if you focus mostly just on the dividend side, you will compromise your long-term growth. The way you're going to cope with trying to make sure your goose doesn't get killed too quickly and cope with inflation and taxes more effectively is look at a more balanced portfolio. So what if we took all these returns and we put 50% in the Canadian market, stock market, 30% in the Canadian bond market, and then 20% in 3-year GICs? Well, that portfolio would have grown by 239%. It didn't do as well, of course, as the pure stock portfolio, but it would have had less total fluctuation because bonds tend to fluctuate inversely to stocks. That tends to smooth out return. And then you add the cash investments, 20% of the portfolio, that further reduces the volatility in the account. So when you're thinking about your retirement portfolio, when you focus just on yield, I think you give up the potential for growth. And the way you deal with the concern about volatility is you have a balanced portfolio or a mix of assets in your portfolio. So rather than being singularly focused just on income, be focused on growth and income, and embrace the idea that maybe over time you'll clip growth or profits from your stock portfolio to backfill for income. And we'll talk about that in a second. Okay, let's bring this presentation home. So what can we summarize as the main takeaway points from this presentation on this one tip for generating retirement income from your portfolio? So first of all, living off interest and dividends is an unrealistic plan for most retirement investors. If you focus just on income, you're likely to go through the goose that lays a golden egg, and if you're not careful, too quickly. Focusing just on yield may cut you off from other sources of cash flow in your portfolio. Think of the price appreciation on assets that will grow for you as a way of clipping profits to produce income. Those particular profits could be far and away the biggest boost to your cash flow over time than the dividend distributions you'll generate from your portfolio. A broader strategy makes more sense. Build a portfolio that provides both income, growth, potential, and liquidity. That's proven to be one of the best strategies for retirees, having all three buckets in the portfolio. In addition to interest and dividends, asset sales to capture capital gains can be an important source of retirement income. Now, you need a mix. You've heard this from me from time to time in our videos. Have a three-bucket approach. You always want to have assets that are there for cash flow. When markets are not producing profits for you, it gives you time to wait till those profits emerge. In the meantime, you've got cash that you can use. So this means focus on total return, not just income generation through dividends and interest. If you focus just on dividends and interest, you potentially will leave an awful lot of profit and income on the table through your retirement years. So what are the building blocks for your retirement income strategy for your portfolio? So this tip we've been talking about really has the following building blocks in terms of implementation. So the first step is your portfolio should include cash, bonds, stocks, potentially assets like real estate, private equity, and infrastructure. So again, you don't want to just focus on income generating investments. You want a mix of investments all contributing to the total return of your portfolio, not just income generation. Each asset class has a unique role in your portfolio. Stocks can deliver price growth over the longer term and pay dividends. And it's not just the dividend income that you use for income, but you clip the profits along the way. Those profits could be substantial over a 20-year period through your retirement. Bonds can generate income through fixed income payments and help stabilize a portfolio during a stock market downturn because they tend to be negatively correlated to the stock market. Not always, but often bonds will rally when stocks go down. And cash and other short-term investments, such as bank deposits, short-term bonds, GICs, And cash accounts offer stability, liquidity, and flexibility when they're needed. You always want to have safe harbor, short-term assets just in case your growth investments are not behaving quite the way you'd like them in the short term. And then finally, very important, your plan, in caps, income needs, risk profile, tax planning, and return objectives will influence your mix of investments and do have a profound impact on your income as well through your retirement years. Well, I hope you enjoyed the video. Again, if you are not a subscriber, make sure you do that so you don't miss future content we're posting on a regular basis. Again, if you go to the show notes, you can find out how you can get a complimentary retirement forecast, as well as some educational resources that are complimentary as well, dealing with different aspects of planning your retirement journey. Anyway, wishing you all the best in your retirement and overall wealth planning. You take care. Bye-bye.